We had our biggest drop that we had in a while today in the stock market on the S&P 500, on the Dow Jones, finally on the Nasdaq and Russell. I'm going to break down what this has done to the intermediate run that we've been on and what our expectations are now going forward from here and how bearish we expect to be. I'm also going to break down where the rotation is happening, where it's coming into, where it's coming out of, and looking for that rotation out for a trade idea. So let's go ahead and get started. Today is Monday, June the 25th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, thanks for tuning in. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking on the Market Scholars logo over here in the bottom right corner of the video screen. Click the red subscribe button that pops out there. Click the thumbs up icon that's down below. That lets me know two things. Number one, it tells me that you found the video useful today. Number two, it tells me you want me to do it again tomorrow. It's a quick way to give us feedback in one click. Comment on anything that stands out to you from today's video. Join our Market Outlook email list by clicking the link that's popping out in the top right corner of your screen up there. Follow us on Twitter for more content like this, and join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 with the market forecast indicator. You can see we pulled down closing at the 62% Fibonacci retracement level. Got down to that 78% on an intraday basis. So pretty decent selling today below the moving average. It's still green, but it's going to turn yellow tomorrow, if not red, depending upon whether it falls, the green line there. You notice we are lightly shaded pink. That does not mean this intermediate run is over with. Obviously, there's a good chance if the intermediate line continues to fall down below the midpoint. You notice the short-term sentiment lines were a lot lower today. That late rally off the close brought them up higher. So they avoided the reversal zone, which would have signified really oversold levels, and a good sign, another good sign that this posture will turn dark pink, right? And that's when the bullish move, the bullish intermediate run does end. And so you can see we're obviously, this is the near term. This was the Fibonacci retracement for the near term rally. Here's the Fibonacci retracement levels for here's the Fibonacci retracement levels for the intermediate rally that we would be ending right now. If we do get to that point, let's see, can I get it down? There we go. And then this would be up to the high. Let's get it up to the highest point here. There we go. So you can see we are, at the close at the 38% Fibonacci retracement right now of this 38% of the current intermediate run. If we do turn dark pink, even if it's just brief, right? Like back here, you can see it was brief. It wasn't very long, and the intermediate line turned around, bounced up. So even if that is the case, if this intermediate run is over and we start, which we are a month and a half, so it wouldn't be out of the ordinary for it to be over. We expect a little bit longer because of market sentiments just rising, just now getting above 50. But if it is indeed over, you can see how we can start, and even with that old high point here sitting at this level, you can see the rest of this kind of buying and selling area sitting between the 23 and the 50% Fibonacci retracement, which is a little bit lower than today's low point. So you can see where there's going to be some support on an intermediate basis, right around that 2700 level. If again, like I said, we do end this intermediate run, which we had, like we talked about before, like we have on the Dow Jones Industrial Average, its intermediate line is below 50. So you do have a dark shaded pink area there. If I were to draw this or activate that Fibonacci retracement line and make sure it's also open, high, low, and close here. So I'll activate that drawing and move it over here, and then bring this one up to the high as well. There we go. You can see it's sitting on currently the 62% Fibonacci retracement on a closing basis today of that past intermediate rally that we started back here. So you can, and again, the prospects of a bullish near-term divergence with the higher lows there and obviously much lower lows here, still set up, even with today's selling, because again, coming off the low points, brought those short-term sentiment lines from their low points on the day. Of course, the Nasdaq Composite finally selling more today than it has. If I were to draw the same Fibonacci retracement levels on its current intermediate rally, which is same very similar spot here. So we'll do it from there up to the high point. We're down to the 38% Fibonacci retracement on intraday basis. So weak bearish posture, light pink shaded area. Its near-term line did falter a little bit, but not too far down below that. You can see we got down there here too on some pretty big selling before bouncing. Finally, the Russell 2000, which has been the most bullish out of all of them. Here, let me activate that drawing and get it to the intermediate level. The intermediate low, which actually started back here, even further away. We're not even yet to the 38% Fibonacci retracement, and we would be, where these old high points are sitting between the 50 and the 38%. So you've got some support for it if it were to continue down. Same thing, oversold. Still got the bullish intermediate confirmation signal that we highlighted on Friday. That's how bullish it was. The fact that we've had 3 down days, pretty steep down days, relatively speaking. We closed below all these days, a couple weeks worth of closes. We closed down in 3 days. And even with that, we're still got a strong bullish posture, according to the intermediate line. And the prospects for a bullish intermediate confirmation signal that's actually... Here, let's draw that. Let's activate that drawing again and bring it to the near-term low point, which is right there. That's actually still sitting at that, 62% Fibonacci retracement of the last near-term low. So, it's kind of, all these selling days, especially the big ones like this, when you put them in perspective, when you look at them in isolation, then that's when I get the tweets and the emails. I knew the market was going to drop, right? You get that quite a bit. I get that. That's how I know. Like I told you before, that's how I know when the markets are down, because I get certain tweets from people reminding me that, hey, the market went down today. Don't get them very often. I just only get them on the down days. So we got them again today. But when you look at them in context, the down days don't seem so bad. Again, you can't go up every day. And every time you do pull back, even on the intermediate basis, they're the worst, right? The near-term pullbacks, there's a little bit of fear and panic. But when you get the intermediate pullbacks, like I mentioned before on the S&P 500, we get this. This is just an intermediate pullback right now. We've got a light shaded pink. There's a pretty good chance it will drop below 50, barring a sharp bounce back rally here. If we were to kind of fill in that candle, maybe get down to 50%, kind of trade in this area. How many people are talking about the prospects of a bear market right now, and all we've done is pull back as of today 38% of what we rallied off of the low point when we started this intermediate rally. So, if we can't handle, Fibonacci retracements, then we're going to have a hard time trading in the markets, because that's what so far, that's what this is. And again, when you're on a trend and the market's got this bullish market sentiment, then you expect, you're going to get multiple intermediate runs. This has been number one. And multiple intermediate runs are always in between them, have intermediate pullbacks where you get the dark shaded pink areas. Back here, let's go 2 years to go to the last market sentiment rally, right? So from this point, we had 1, 2, 3. Let's see, 1 on this is on the Dow Jones. Sorry, that's on the S&P. There was 4, but on the Dow, there's 1, 2, 3 intermediate rallies, big ones, and in between you had some pretty, multiple month pullbacks, sideways moves. Here was a whole month where we just didn't do anything, and so. Of course, here's a market sentiment pullback, which happened to be 38% of the rally, we got off this low point, the last time the orange line dropped below 50. So we're dropping below 50 now. Market sentiment's pulling back a little bit so far on the Dow, and we'll see if it ends up being anything, if we end up getting any more than a pullback, or if this bullish near-term divergence will bounce up. Again, the expectation is, considering everything else we look at, the NASDAQ and the Russell, is that after these pullbacks, we'll get bounces and continue to trend higher. And we even talked about, too, from a seasonality perspective, the after June expiration into the end of the month, it's a typical weak period for stocks. In fact, I remember Brandon tweeted out afterwards, about that. The fact that we had mentioned it here on the Market Outlook video. And so, and again, like we've talked about before, too. So here's the seasonality chart for the S&P 500, and there's the weakness that we typically get at the after June expiration into the end of the month. We're getting it right now. Typically from this end of the month period to July expiration, we typically get a rally. It doesn't mean we have to. That's just the season, right? That's the seasonality for it, and we'll see if that ends up being the case. And you can see typically, the weakness we get here at the end of the month compared to when we rally off of these lows in May, because usually the sell in May, go away crowd actually produces a rally. So you get a lot of people sure willing to buy from the sell in May crowd. You usually get a rally here, and you can see, we've pulled back a little higher. Usually it's just a little bit of higher low point at the end of June than where we started May. Now, obviously, we're a lot higher right now at the end of June from where we started in May. So that the seasonality is still playing out, and we'll see if it continues to play out for the next few weeks into that July expiration. Before we look at other charts, I do want to remind you, if you're watching here on the blog, we're looking, just scroll down below the video. There's the video. Scroll down below. We're looking for 3 clicks. 3 clicks to tell us that you want us to keep doing these videos. We look at it day in and day out. That's our way to get feedback. So if you think you got some value out of this video, you want us to keep doing them, click the like button right there on today's tweet. Click the thumbs up here on the Facebook post, and then click that green thumbs up right there. Remember, you can subscribe to our daily email list. I'm actually building a page. The daily Market Outlook email has a list of all the overbought and oversold clusters. So I'm building a page on the site here, and that will be released next week when we launch our new site. That will keep track of all those stocks that are in those clusters. We have a way to see how many of them turn into buying opportunities or not. So that's gonna be a watch list for Market Scholar subscribers, not just the email subscribers, but those who subscribe to our site. There'll be a premium watch list for them to see what those stocks are. I mean, you can get those stocks here, but then we're gonna build out a way to track and see whether they're good buying opportunities now when they're oversold clusters, or when they will be if they're not now. So that's something, again, you'll get access to the list, from day to day with the email list, but we'll keep track of those stocks after, each day going forward with the new page that we're building for the new site. Remember, you can still subscribe. This is our last week that we're offering the discount offer. The early access period is almost over. If you subscribe, you still get access to all the 200 hours of content that we've created during our beta period on our website. This is our beta website that you're seeing here. So you'll get access to all that content. But this is the last week that we're offering a year off. So we've been offering anybody who subscribes, and you'll see all the information by going to this link right here. We've been offering people a year off because we're building a site, and we'll be building a site for the next 12 months. And so because of that, we wanted to make sure people had a discount for subscribing to it, and that's where you can get that discount there. There's been a lot of people that have already done that. Here's some, if you go to this link right here, there's some comments in the forums on Market Scholars here where people talk about what they've gotten out of it. So if you're wondering whether you should still do it, and you're looking for some ideas on how it would benefit you, go to that link here. If you click on that link, it brings up the email that we've sent out. There, you click that button to subscribe, and then go down here and click on that link. There's some really, really good comments from other market scholars on what they've gotten out of it, so you can kind of get an idea. All right, back to the charts. You see, hey, we got an arrow. We got an arrow on the 50-day moving average. Now remember, that arrow only stays at the end of the week, so we're only a day into this. We'll see if we end up finishing the week above the 50-day moving average or below it. Right now, obviously below it. You can see enough below it that the moving average has dropped, the 50-day moving average here. And you can also see, too, that the gap, but because it dropped and the 200 is still rising, the MACD has dropped. And it's pulled back. And, we expect that. We expect it to go up and down, and we've had a little period of ups. The week's not over with, but as of right now, it's expected to get. See, we picture we're in this kind of period where we're starting to get more frequent arrows than what we had in all of 2017. And so, we're getting more frequent arrows. Sometimes they might even test the 200-day moving average before bouncing, but that's the expectation. That's what we expect during this period of time. You see that on the Dow. You see the S&P, that's the S&P. The Dow is close to its 200-day moving average. In this case, a 40-week exponential moving average. You also see the NASDAQ is still easily above its 50, which is way up above its 200. So context in terms of how that's not a really bearish pattern right there. And the same thing with the Russell 2000, that kind of bearish candlestick that we highlighted Friday. It's pulled back too, but still its momentum, its long-term momentum is still very strong. You can tank down to the 200-day moving average from these levels, in this case in 2 weeks, but you notice it's hard for it to hold. Again, we tanked down in 4 weeks at these high levels, and it's hard for it to hold. It's hard to fall off a cliff from a bearish standpoint when you're at such bullish markets. It's easy to get the buyers, it's easy to run out of sellers when you come down so hard, so fast. Buyers tend to come in and scoop up pretty quickly. You generally want to try to get rid of a lot of the buyers by just kind of going sideways and meandering like you see on the S&P. Then you can go down and stay down for a little bit below that 200-day moving average. All right, you see we got 3 red arrows now, so we have a pink shaded area here with dropping below the moving average on the S&P 500. The MACD and stochastics are also down. You can see if I look at the 2-line version of those lines, the MACD now is below 0, which means the 8-day is a smidgen below the 200-day or the 17-day up here where my cursor is. They're both still above the 17, so we're not too bearish there yet, and the stochastics has got a smidgen below 50 as well. So, we're getting increasingly bearish, but not, again, not strongly bearish on the technicals quite yet. Of course, if I were to look at, like the Russell 2000 with the same thing, we are still above the 30-day moving average, and the MACD and the stochastics are easily up in the upper half of their charts. Same thing with the NASDAQ composite. Similar look, a little bit below the 200-day moving average. But not much. And you can see when you look at some of these charts at the S&P 500, the SPY getting a strong volume here, above average volume, bigger volume than we've had since back here where my cursor is, and we bounced off that volume. And then bigger, we haven't had this much volume since these days either, which also were marked low points that we bounced off of. So strong volume coming out of nowhere. Usually you kind of build into the strong volume. You see how we started to build into this average volume, and then we had some, well, here kind of it's come out of nowhere. We had really low volume, a few days of higher volume on these downward moves to support, but today's volume kind of coming out of nowhere in terms of being the highest number we've had for a while. That's on SPY. If you look at IWM, we've had multiple days here of heavy selling, similar to what you see in this kind of an area. So again, when it kind of comes out of nowhere and we get strong above average consecutive here very quickly like this, we tend to find a low point. You tend to find willing buyers at cheaper levels willing to come in and scoop up, and we'll see if that ends up being the case. And we expect that to be the case simply because of the trend, not because of a positive bias, but because of the trend. At least on IWM right now, we're still above a rising moving average, so you'd expect the buyers to come in, until things get more bearish on some of these technical indicators. All right, so if you look at the intraday chart, you can see why we were so bearish today. We broke into the lower half of the trading range. And in fact, pretty darn soon, after another day of trading, today is going to be the 4-week low point. This is going to be the 4-week low point because we've broken below that low point too, which is right around the 78% Fibonacci retracement. So you can see now we'll be trading much, much closer. You can see all the volume too, see the average, how it kind of spiked up. And also see the last time we had it this high, the average volume on an hourly chart like this, we got the low points and we got the bounces. So a lot of volume in a small amount of time, again, coming out of nowhere, tends to attract a lot of buyers, a lot of value hunters that you're seeing. So we'll see if that ends up being the case on today's. But bearish candle, lower high, lower low, closing below last week's low point, closing below yesterday's low point, and pretty much setting. Haven't closed below the 4-week low point yet, but pretty much setting what will be the 4-week low point after another day. You look at the trading range today. The trading range was about without the gap, 4.5 points, and you can see today's high 273.62, the close here 274. So we're looking at another point. So including the gap, you got about a 5.5 point range in today's move. If you were to look at that on the ATR, and here let's pull up to the regular. So this is the absolute value, and this ratio is the relative value. So both of them rose. You can see today's range was extreme. The volume was relatively extreme too. Let's go back here. Let's add this really quick. If you go back to this chart here and look at SPY. You can see the volume is 137 million, so more than 1.5 times the average volume. So now you compare that 137 million, that's up here. So it's close to the high end. So that's actually not too extreme. It's pretty high, but the trading range is higher than the 52-week high. So that's a big trading range. Again, extreme trading ranges and big volumes. If you're going to get bearish, you want the trading ranges to be 3 to 4 points and the volume between 100 and 125 million, and then build into higher numbers. And we never had that. We've kind of spiked in one fell swoop. Finally, if you look at volatility, which also spiked today, you see getting all the way up to 20 almost, getting up to the high point we had back here at the end of May before falling back down. Obviously, coming up off of what was a higher low point that was formed on Friday. We didn't know it was formed on Friday. It was forming Friday, but we didn't know it was formed because we didn't know what's going to happen today. Today we did bounce up, so it did form a higher low and obviously much higher high point than what we've seen. And then you can also see too, when you look at volatility relative to VXV, it really jumped up as well, and it got all the way up to to this high level 1, where we finished today at 1738, and if you look at VIX 3-month, it finished at 1759. So, we were just a smidgen below 1733, and then you look at VIX 3-month, 1752. So that's what this is measuring here. If VIX was at 1752, then we would have finished right at 1. So finished just a little bit below 1. That's temporary. You can see it did it over here too, and we came back down. So we've gone from the bullish zone through the neutral area, and we're smack dab in the bearish zone. And we'll see, again, if that continues to be the case. So we're getting more risk factors. The posture is getting more bearish here. So we can talk about it like this way. So summarizing, the market is getting more bearish. Not bearish enough to say, now we are in bear market mode or we're in a bearish trend. It is bearish enough that this intermediate run that we're on appears to be ending. It didn't quite make it. It came close to 2 months. We were expecting 2 to 3. So we're coming close to 2. And there's some bearish technical signs, but none yet that would suggest that this isn't anything more than an intermediate term pullback, which are obviously bigger than near-term pullbacks because intermediate runs are bigger and longer than near-term runs are. So right now we are looking at this still as an intermediate pullback, ending the first intermediate run on this current long-term run that we're on the market sentiment. We talked about this current long-term run. It's not going to look like the last one. 2017 was such an anomaly. It had two very extended intermediate rallies out of the four. We talked about, this current market sentiment run is going to look a lot more like the summer, where they were shorter intermediate rallies. We got more frequent pullbacks, and so that's what I expect here. And this appears to be the end of the first one, and appears to be setting up Fibonacci retracement areas for a bounce into a new one. And we'll see if that ends up being the case. So now is a good chance here that there's a poll popping out of the top right corner. Now's a chance to let me know what you think. Do you agree with that? Do you disagree with that? You don't have to agree with that, and obviously not everybody does. So now's your chance. If you are bearish, to say I was right all along. Finally, I was right all along, and tell me down below what you're thinking, what you're seeing, and that would suggest that we should be a lot more bearish than expecting this to just be a pullback move. So comment down below whether it's on the YouTube channel or on the blog post down there. All right, now let's transition into what's driving the market action here. This is the relative performance over the last couple of weeks. You can see crude oil continues to be the best performer with this breakout move that we had on Friday. Long-term bonds, you can see the U.S. dollar, high-yield bonds up here, HYG, the purple preferred stocks, foreign bonds. So these are all relatively safe haven trades over the past 2 weeks. All outperforming, and you can see here's all your more risk appetite type trades. The small cap index outpacing large caps. There's your commodity basket, which is being impacted by that tariff news. Gold also struggling with the relative strength in the dollar. And then there's your international stocks struggling the most. Emerging markets getting hit hard. That's over the last couple of weeks. Just looking at today, this was a brisk off day today. So long-term bonds didn't go up a whole lot. They barely went up at all, actually. But they outperformed. They were the only asset class in the positive out of this particular list. There was a dollar, gold, and high-yield bonds all outpacing all these equity asset classes and crude oil, all down here at the bottom. Pretty much all together, too. So this was a broad risk-off move. When stocks sell off, correlations tend to get high, 100%. So that's what we've seen today. When we look at the countries and how they're doing, relatively speaking to each other, you can see that the countries that kind of held up today were Russia, Brazil and Mexico, both of these. Mexico actually rising, and Brazil holding its value. But Canada, United Kingdom, look how far below they are, below their moving averages. South Africa, reflection of gold. Japan, China, all of these, Australia, again, commodity prices with Canada. A lot of these are down below some pretty sharp moving averages, whereas the S&P has just barely crossed below its rising moving average. It's the only one out of all these foreign markets that's down below its rising moving average there. All right, so I've reordered these by the size of their economy. So obviously the U.S. economy being the biggest over here, and then China, Japan, Germany, UK, this would be France, India, Italy. So we have a lot of European countries here, Brazil, Canada, Russia, and then Korea. So, I mean, you look at a reflection of all the major world economies and this idea of tariffs and trade wars. You can see all of these countries are pink. All of the major economies are showing bearish postures. Germany's below 10. So is Japan. So is China. So is UK. So is France. India is below 50 and falling. Italy is below 10. The United States is above 65. Brazil is below 10. Canada is almost below 10. Russia's got a rising intermediate, the only one that's rising, and South Korea is below 10. So, I mean, this is kind of a broad-based, and you can see how far below falling moving average. All the moving averages are red. This one will be red tomorrow with today's drop. They're all red. Some of them have been red the whole 3 months. Some of them are just barely turning red. China's just barely turned red. The U.S. is not red yet. The UK has just barely turned red. Japan's just barely turned. Some have been red for about half the time, like Italy and Germany, South Korea to an extent. So, I mean, we have some bearish postures here across some, multiples of these indexes. You can see their 3-month returns in red. The U.S. is up 2.2% over the last 3 months. Canada is up 2.19%. Those are the only two positives. The worst is Brazil, down to over 25%. China is almost down 10%. And Italy and South Korea are almost down 10%. So you can see kind of who the losers so far of, and then of course here's Germany down almost 6%. And Russia down 7%. But you can see kind of what the losers are so far, just from a sentiment standpoint, reflected by prices, right? By stock prices, what investors can impact according to what they think can happen. What we're being a lot more impacted abroad so far than we are here in the U.S. Remember, this is an either-or game. So if money comes out of here, it's got to go somewhere else. Among most of these, typically another major economy. And right now, there's not a whole lot of better alternatives. There's a lot more oversold alternatives, but there aren't a lot of better alternatives here from a trending standpoint than what we're seeing right now here in the U.S. If you look at the sector rotation charts here, you can see staples and utilities actually rallied on the day. You can see their charts here, both of them up. Real estate outperforming, but slightly lower, and then everything else down, with technology, energy, and discretionary kind of leading the way to the downside. You can see those, I've got them sorted here by order of their biggest losses. Those two have been the most bullish. They've pulled back finally, giving up some of their gains. I saw a funny tweet on Twitter that said, did they put a tariff on Netflix, right? Because that's obviously Netflix came down quite a bit. And there's been other things. Harley Davidson's a trade that we've looked at recently on this video. It had a down day today. Dominion's another trade we did recently, and it's actually had a good day today. In fact, utilities is breaking out to higher highs that we had. And you can see Staples continuing to trend higher. So they have strong, look how quickly those intermediate postures have turned around. Real estate down a smidgen, but holding up some pretty good gains and a strong bullish posture above a rising moving average. It's better you can say for everything else, most everything else. The only thing else that's still above its moving average is healthcare, another considered safe haven area, and discretionary. Everything else is now either going to show a yellow line. This one will be red tomorrow because that line is going to be moving down. There's the S&P 500. But look at all the other red lines, and this one will be red tomorrow too if we stay below the moving average. So you can see there's your, these two industrials and materials are your two tariff kind of related sectors, kind of matching the market. So you can see how it was, that's what the market was. That's what the drop was today. A move into safety and a move away from leadership, previous leadership into safety. And you can see the discretionary's got, it's been so bullish. It actually still shows a bullish posture. It's the only one out of the safe havens that shows a bullish posture. Everything else is either, they're all falling. That's why they're all pink, but to different degrees, right? So you have technology, which is, and telecom and healthcare, which are all still kind of in the upper half of the chart. So bearish, but to a lesser degree. And then the more bullish sectors are your industrials, materials. They're the only ones that are below 20 with the potential for clusters forming. And then, of course, energy is close to being below 20 here. So you can see which ones are being hit the most right now, and it's finally dragging leadership down with it, but it's moving things. Not everything's going down, which is what happens when it's a really broad risk-off move. it's just rotating into safe haven areas. There's still things that are actually going up. So one stock that's showing that's in one of those sectors that has been showing leadership that obviously is not anymore is that technology sector. And Cisco is one of the bigger companies, bigger names within that sector. Obviously not the biggest. Today, kind of showing a little bit of a breakdown today. You see it's obviously got a bearish market forecast. This intermediate line coming down from what would be a phantom green arrow, or red arrow, excuse me, without getting above 50. It's already turning down. And it would be a lower high point there, breaking through the prior intermediate low point. I've also kind of drawn, there's a little bit of a head and shoulders pattern here on a tilted basis. I've drawn a line coming across those lows using the open and the closes, and you can see we kind of crossed below that too, below those lines, falling moving average. You can see we're also on the 3 green arrow chart for Cisco. You can see it's also pink, which means we have 3 red arrows here. If you look at the 2 line versions of those lines, you can see the moving average is declining below its moving average. Same thing with the stochastics. Long-term chart, you can see that is actually still up above the 50, still above the 200. So there's no danger here of a bearish posture. You can see that we are crossing below. We finished last week below the 50-day moving average, and you can see how bearish today's move is, closing below 1, 2, 3, 4, 5, 6 weeks lows, and even below before that, multiple weeks of low points. And then you look at like the intraday chart, and you can see today we formed a new 4-week low point for the first time. So there was the lows on Friday up above the 4-week lows, today forming a new one. So pretty bearish. You can see where the gap is. You can see kind of 43, 40, this 42 and a half, a little bit of a dead cat bounce potential here coming into the end of the day. Again, not that the whole market's going down, because we see that there's markets shifting, stocks shifting into safe haven areas, shifting out of former leadership, and we can see a little bit of that rotation. We've looked at trend trades in like the utility sector and the staples sector, and now we'll take a look at a bearish trade in some of these previous leaderships, like Cisco, for example. We can look at selling call options because we're not too strongly bearish here on the market as a whole, but it doesn't mean that we can't have some bearish trades in our active trading portfolio. So we'll look at selling that 40 delta, selling the 43 strike, buying the 45, getting about the amount of credit you need to get a 30% return on risk. You can see that gives me a pretty decent odds of success, and the blue line you see on that chart right here, this blue line, is where that break-even point is. So we'd have to break back into the gap, back up above these highs for us to get to break even. And you remember, we still got a little bit beyond that, so about right into this area, up to 44, which is where you would get to the loss that's equivalent to what you're trying to make, and that's when we get out of the trade in the worst case scenario. So essentially, if we hold these highs here, then we're fine. Now you can do whatever it wants to. If it holds those high, once it breaks up above those highs, then this whole narrative is gone. And then we'd be back in, we'd close out that trade and obviously be looking for more bullish trades elsewhere. So, or even here if it gives us a good opportunity. So what do you think about today's trade idea? What do you think about the market posture? Let me know in our market outlook forums on marketscholars.com. There's a link that's popping out in the top right corner. Any comments, any questions you have for me, let me know there. And of course you can interact and answer and comment on other people's comments as well. That's the whole thing of a forum. So as always, thank you very much for watching tonight. Remember to subscribe to our YouTube channel, like today's video, and comment on it down below. Also remember to follow on Twitter for more content like this, and join our Market Outlook community on Facebook if you haven't already. Have a great evening, everybody, and we'll see you all next time.